So this topic is on derivatives and alternative investment. Usually alternative and these derivatives are a small portion of the total investment, and usually is no more than 10% usually. So now, although it's not that huge amount investment, but this can use as a hedging. Okay, so derivatives and alternative investment can use as a hedging. It becomes very important. So what are they? They are options, futures, swap, forward and swap. And later I'll explain to you the difference between them, and hedging is the important one. And also for alternate investment, you can use as a hedging as well. So derivatives instrument. So we have forward, which is over the counter. So it's actually is like referring to banks. So futures is like exchange, and is just take it as Singapore Stock Exchange (SGX). Therefore, you buy the futures from the stock exchange, which is usually more inconvenient because there's no one to serve you rather than you go to internet and buy. So swap is always over the counter, and there's always a banker to assist you for that. So for options, it depends. If you're very familiar, you should go to the exchange, which is lesser cost. And if you're not familiar, then you should go for banker, which is over the counter. Forward contract, what does that mean? I like to buy 100 barrels of your crude oil. Okay. So buy means long, right? Short means I want to sell. So, but you must say when, So I will buy maybe say 10 months later, 3 months later. So it's always the next one. So future contract is the same, but the problem is you are not delivering the barrels, but rather you close the contract. So when you buy 10, then you sell 10, then your contract closed. Comparing forward and futures, and forward is always better in the sense that it's convenient and most likely you use that. Futures is more inconvenient, The reason is because these futures, you will face some problem in terms of buying. Do you buy the correct things or not? Okay, so that's a problem. Swap. So we have currency swap, interest rate swap, and equity swap. So it means, for example, currency swap means I give you a US dollar, you give me a Sing dollar. Interest rate means I give you a fixed, you give me a float. Equity swap, maybe I swap index, STI against, let's say, Dow. So options, so you always have the call options, and of course you can buy, sell call options. So the seller is always called the writer as well, or quite short, and the buyer is a long. Okay, and put, the same thing. You can sell put, buy put. So the difference is that when you sell put, that means that you're selling the option to sell. When you buy put, means you're buying the option to sell. Okay, then call means option to buy. So you can sell an option to buy, or you can buy an option to buy. So they are altogether 4 permutation. So forward contract can be commodities, equities, bonds, interest rate, and currency. LIBOR, despite the first word is London, but actually it means international. Okay, so euro currency means that the currency held outside its domestic market. So euro dollar means US outside, trading outside US. Okay, so euro yen means the yen that is outside Japan. So euro is, again, is a London. It doesn't mean the euro that we always commonly used. Okay. So forward rate agreement is so popular that today we actually look at FRA as a product itself, but actually it's talking about interest rate. So you buy a FRA, if the interest rate go up, you make money. And you sell a FRA, if the interest rate goes down, you make money. That's it. Okay. Swap means you must have someone that wanted to buy the things from you, and you wanted to sell him the things that he liked. So for example, you can be swapping index. I want to swap Sing, STI, and Dow, or I want to swap fixed rate against float rate. So this is something that you can swap, or swap currency. I want to swap Sing dollar with US dollar, for example, right? Alternative investment, hedge fund, private equity, real estate. So, let's see what is alternative investment. A common characteristic is that it's illiquid and it has low correlation with the traditional investment. Therefore, it's very good for hedging. Common characteristic, you restrict from selling to the public. Usually, it was only those AI accredited investors allowed to do that. The fee structure is always 2% around, plus minus 2% of the asset under management, AUM, and 20% of the profit. So that is is a watermark. So event-driven strategy, merger arbitrage, and can be distress restructuring, etc. So certain event like COVID, you may want to buy some pharmaceutical share, etc. Relative value strategies, including fixed income, volatility, etc. And some macro strategy that you can probably look at, like for example, GDP, interest rate, exchange rate. So private equity is usually talking about non-listed company. So you can actually invest, like limited partners put in the money. General partners is like the board of director to run the fund. And then you can invest in company one, company two. Of course, sometimes you make a lot of money, like SBI invested in Alibaba and make a lot of money. Private equity strategy can be low stock price because the share price is very low because they haven't listed yet, right? Willing management, inefficient companies, long and stable cash flow, low leverage, and some assets. So some private limited has a lot of assets. There's something that you can look into. So strategy can be venture capitalist, can be formative stage in a very early stage, angel, seed, and early stage. And later stage, pre-IPO, mezzanine. So you need some money before IPO, etc. So exit IPO is the most popular one. So when it's IPO, you can sell in the market. Secondary sales is possible. Write off, liquidation, both can, right? Real estate, you can directly own it. You can leverage from the ownership. You can even buy REITs, or you can buy mortgage-backed securities like bonds, etc. But it's mortgage-backed. So real estate valuation, comparable sales approach, cost approach, income approach. I'm quite sure you want to buy a property, you can easily use any of these, right? So the neighbor sell 3 million, most likely the next door is also 3 million. Commodity, very popular now, gold and silver, right? Gold has been going up a lot. So it's very low correlation with equity. When the equity goes down, which is now, but the gold actually went up, right? So also agriculture is possible, energy, metals. Long hedge is to hedge the price increase. So let's say, for example, you worry the price increase when you need that, for example, a commodity. If you need rice, then you do a long hedge if you worry. But if you're a seller, you probably have to short because you worry about you can't sell in the future. Okay. So short hedge. Okay, so this is more for the farmer because you have to sell future, right? Because when you harvest, you have to sell it. Hedging using alternative investment. So, for example, property, gold. Currently, gold is the hottest and definitely very useful. And that's all for the derivative and alternative.